welcome to the Monday edition of Dividend Cafe. I am very happy to be recording from our beautiful downtown Nashville office here at the Bahnsen Group. I will be in Nashville all week. There is a lot going on in the world. There's a lot going on in markets. I should add, there's a lot of stuff not going on in the world too. A lot of noise, commotion that adds to news cycle, political hysteria, things like that. But no, there's some real things going on that I think are relevant to where we are in the economy and public policy and certainly markets too. And so I'm going to try to cover some of these things here for you today. And I anticipate being with you each day this week in terms of the what's on David's mind and Ask TBG. I have a lot on my mind, and I want to try to share it with you each day and come into a special Dividend Cafe on Friday. But in terms of just kind of where we are on markets, there's some links at dividendcafe.com today. NVIDIA is a huge company, and there's a link about some things going on there in Dividend Cafe today that obviously has a profound impact on overall markets, being a $3.3 trillion company. I happen to have a little discussion, shall we say, that it was a rare heated discussion. I don't have a lot of those with media, and that we put the link in Dividend Cafe. But the reason why it's sort of relevant to non-NVIDIA investors and just broad market actors is AI capex, valuations. It ties into other stories that impact everybody. And there was today a news story about Microsoft canceling leases for some data center expansions they've been working on. And I just want to reiterate that the hyperscalers are in this sort of pro-cyclical loop with the customers, that the hyperscalers are growing because they're hyperscaling, and the people that feed the chips and infrastructure to the scalers are growing because they're the customers getting the big checks from them. And if something breaks down in that, there's impact in utilities, in power demand, and data center, and certainly in the underlying companies. So we want to follow all of that and as much as possible not be really overly levered to it. Um, the market today, the Dow ended up being up 33 points. It opened up, fell in a negative territory quickly, rallied way higher. Then at the final minutes of trading, gave most of that back. But again, it did close up 33 points, largely with healthcare and energy and things like that leading the way. But the NASDAQ was down a full 1.2%, even coming off the big sell-off from last week, Friday. And the S&P was down half a percentage point as well. And that, again, was technology down almost 1.5% today. So those are some of the stories that went into it. When I say healthcare was the lead, it was up 0.75 of a point. So pretty good day there. Bonds were up today as the 10-year yield fell 2 basis points to 4.4, putting a little bit of upward pricing movement on the long bond. NVIDIA is the last of the Mag 7 names that will be releasing their earnings. And, almost 90% of the S&P has now released last quarter's results. But NVIDIA will be the last of the Mag 7. The total guidance for Mag 7 names for 2025 earnings, which is such a huge part of total S&P 500 earnings, the guidance range has now seen a lower low than it started with, but a higher high. So you just have a kind of wider range of guidance outcomes for 2025. Not super healthy at this time. Only 60% of names in the S&P 500 right now are trading above their 200-day moving average. That's not catastrophic, but it's not robust. It's vulnerable in terms of breadth. And then the Russell 2000 small cap, it's about 45%. It's less than half. So, we're just kind of treading water here in some of those market names, but a lot of defensives, a lot of dividend growth value stuff is doing quite well. But there, who knows? I mean, there's definitely a kind of pause feel of vulnerability around markets. One of the final comments I'll make on markets before we go into some news and policy and other things today is the concentration issue I bring up a lot. It's easy to think of it as a story, and I think of it largely as a story about U.S. investors being overly concentrated in U.S. markets, which is a great thing relative to what international markets have done for a long time. But then with that concentration, bidding up, a very select few names, making top-heavy markets. One thing I don't think I've written about a lot is the way in which non-U.S. investors have overly concentrated in U.S. markets and then concentrated themselves in a lot of the tech, large cap growth, kind of Mag 7 type names. So you have sort of two concentrations, and they're both centering around US play with non-US investors. So there is a good story in there that the US is still just such an incredibly attractive place for capital flows. Um, that speaks to US, I think, dynamism and innovation. But you got to remember that non-US investors are also human beings, and like domestic investors, are susceptible to buy into euphoria and discipline, logic, these things that are kind of the very important components that we want out of domestic investors that we serve. You got to realize that they're not always there with non-US investors either. And so human nature crosses borders. Let's put it that way. Germany had its election yesterday. The center right, Friedrich Merz and his party. Friedrich is the new chancellor. That it was a pretty overwhelming victory. The far right party came in second place, so it was a trouncing of the Social Democrats, coming into a really stunning third place. It's going to be very difficult to build a coalition. You look at the warring factions in American politics. This is a mess in Germany, and so we shall see how a coalition gets formed. But some of the far left and far right elements did not take place, but even the center right's going to have difficult time without some sort of compromise. Yeah, we'll keep you posted in terms of where it's relevant to markets. In the public policy front here, there is a meeting going on, probably as I'm recording right now, with the House Rules Committee. But it's a very sensitive thing to thread this needle with where they're going to come up with spending cuts. And it's largely going to have to come from Medicaid to some degree, but they can do that without cutting any Medicaid. They can do it by reducing the future growth of Medicaid benefits that the federal government pays to states in the future. But they don't have a lot of margin of error there for all the reasons I've talked about before. Reduction in expectations of growth in those entitlement programs is sensible, but it's also needed. They're not going to get to the budget that they need. The politics are tricky. The math is not tricky. And we'll see what happens. I do find it kind of funny, but also just relevant. The Doge website has a tab of savings with an itemization, and they're saying they've now saved $55 billion so far. But it turned out that one of the kind of canceled contracts they're touting as an $8 billion savings was an $8 million savings. So, government inefficiencies are tough, even websites about government inefficiencies. Some may not find it funny, but I promise you it is. And also speaks to a broader complexity and challenge of the day. There's a few bullet points I have today on housing. I just want to point out that housing starts came in January at 1.36 million. That was below estimates by a little bit, but it was below last year's number by a lot. Single family starts was below 1 million. That's the far more important number in terms of clearing the housing market than multifamily. Existing home sales were down 4.9% in January. The median sales price was down a little bit on the month, but it was still up 4.8% from a year ago. The annual pace of total sales activity is around 4 million, way below the 5.25 million before COVID, and way below the 6.5 million pace that we saw during 2020, 21 into early 22, kind of the COVID moment. So that's where we are. Nothing's really changed. I have a chart at Dividend Cafe about the maturity wall of debt with commercial real estate, and you get a chance to see why, particularly multifamily, there's so much debt resetting that's very relevant to the state of affairs we're in. The Fed is very likely going to be terminating quantitative tightening earlier even than I expected. I definitely had a theme of the year that it would be done by the end of the year. At this point, I cannot imagine it makes it to June. And my friends at Strategic Research are forecasting a March termination just based on debt ceiling issues going into April and the complexities it creates about liquidity for Treasury as bank reserves get much lower if when they raise the debt ceiling. And so, in the meantime, I think it's relevant from a market standpoint because if they are right now tightening with the balance sheet but loosening with Fed funds rate, and then they end up stopping the reduction of the Fed funds rate, pause for a little bit, maybe don't cut till May or cut till June. There's a 62% chance the next cut will be in June, only a 28% chance the next cut will be in May. But if they, in the meantime, stop the 25 billion a month of tightening, it enables them to be doing a sort of backdoor easing of monetary policy without touching the Fed funds rate, which it provides a little cover, shall we say. Very encouraged by what we saw in the midstream sector in bottom up company results throughout this earnings season. The macro factors are what they are, but micro, we like, the bottom up activity. Again, there's, individual companies doing acquisitions, making capital expenditure commitments, managing their own balance sheets, being productive or unproductive, whatever they're doing. That's really ultimately it drives things, but we get focused on the macro side a lot around natural gas, around liquids extraction, around permitting, regulatory environment. All the macro stuff matters, but micro, bottom up, really healthy beginning to the year in midstream. Oil, by the way, was up, I think, 0.7% today, still just right at around $71 a barrel. Check out every day, dividendcafe.com. We have an Ask TBG where we're posting answers to your questions. They're real life questions coming all the time. And like I said, there'll be a few, additional things on my mind throughout the week I'll be in touch with you on. And then we'll look for a bigger Dividend Cafe Friday. I'm going to leave it there for now. Thanks for listening. Thank you for watching. Thank you for reading the Dividend Cafe.